Hello. Uh, the next topic in the Principles and Practice of Banking Unit 4 is Foreign Exchange Market and FEMA. Now, what is this foreign exchange market? Let us try to understand. It is a market in which foreign currencies are bought and sold. The participants in the market are individuals, firms, foreign exchange brokers, commercial banks, and the central bank, of course. The market in which the currencies are bought and sold. The transactions in this market are not confined only one or few foreign currencies. In fact, there are a large number of foreign currencies which are traded, converted, and exchanged in this market. So, what are the functions of foreign exchange market? The first function is transfer of funds through one currency of a country to another currency. The second function is credit function, whereby the short-term credits to finance trade between countries through various credit instruments are permitted. The third function in a foreign exchange market is hedging function. This is to facilitate avoidance of foreign exchange risks. Let us have a look at the origin and instruments in the Forex market. It is an interbank market that took shape in 1971 when global trade shifted from fixed exchange rates to floating rates ones. Spot, forward, future, swap, options are few instruments which are traded in the Forex market. It is a 24-hour market. Throughout the world, different timings are there. So naturally, when one market closes, the another opens. So continuously, trading takes place for 24 hours. That is why it is called as a 24-hour market. And it does not depend on certain business hours of foreign exchange because the trade takes place among banks located in different corners of the globe. In India, the market, if we want to see the origin, it can be traced back to 1978 when banks in India were permitted to undertake intraday trade in foreign exchange. The exchange rate of rupee that was pegged earlier was floated partially in March 1992 and fully in March 1993. This was done based on the recommendations of the report of High-Level Committee on Balance of Payments, which was headed by Dr. C. Rangarajan. The further developments of the Forex market, let us have a look at it. The RBI had set up several committees. One of them was an expert group headed by O.P. Sodhani, and this group made several recommendations for deepening and widening the Indian foreign exchange market. The recommendations of this committee were implemented during the latter half of the 1990s. The foreign exchange market in India till early 90s had remained highly regulated. The regulations given by the regulators were strictly to be followed. The regulations pertain to restrictions on external transactions, barriers to entry, low liquidity, and high transaction costs. The exchange rate during this period was managed mainly for facilitating India's imports. Strict control on foreign exchange transactions through the Foreign Exchange Regulation Act, This resulted into one of the largest and most efficient parallel market, which is popularly known as Hawala market. Let us have a look at the structure of foreign exchange market in India. The foreign exchange market can be divided into one, the regulators, Reserve Bank of India. Second is central government. The government passes various acts and rules. The RBI as a regulating authority regulates the implementation of the rules framed by the government of India. The RBI appoints authorized persons, and there is an advisory body called as FEDI. We'll have a look as to what are the functions of FEDI in the subsequent slides. There are authorized dealers and authorized money changers. And authorized money changers again are divided into two classes. One is called as full-fledged money changer, and the second one is called as restricted money changers. Let us have a look at what is this FEDI. FEDI, the Foreign Exchange Dealers Association of India, is a non-profit making body formed in 1958 with the approval of RBI. The members of this FEDI are authorized dealers, and FEDI prescribes guidelines and rules for the game for market operations, merchant rates, quotations, delivery dates, holidays, interest rates on defaults, etc. It also advises RBI on market-related issues and helps RBI on strengthening the market. Who are authorized dealers? RBI has issued authorized dealer licenses to banks, all India financial institutions, and a few cooperative banks to undertake foreign exchange transactions in India. It has also issued money changer licenses to large number of established firms, companies, hotels, shops, etc. When you come to the airport or enter a big hotel, you will find money changing is possible, particularly the foreign currency which you want to convert into Indian rupees, or if you are going abroad, if you want to change your rupees into specified currencies of whatever you require, there are money changers available at these points. The money changers help in encashment of foreign currencies of foreign tourists as well as Indian tourists if they are coming from abroad. Entities who are authorized to buy and sell foreign currency, notes, coins, and traveler checks are called as full-fledged money changers. And those entities who are allowed to only buy the foreign currency are called as restricted money changers. The authorized dealers are divided into three categories. The category A, they can undertake all types of forex transactions, and they also are authorized to establish dealing room to handle such transactions. Category B authorized dealers are those branches of the bank handling all types of forex transactions and reporting to dealing room desk of their bank. These branches, however, cannot undertake dealing room operations, which can be undertaken only by category A authorized dealers. Category C includes those branches which can undertake only limited type of transactions like sale and purchase of foreign currency, traveler checks, etc. What are the measures taken by the government and the RBI in developing the foreign exchange market in India? As we said earlier, initial period The Foreign Exchange Regulation Act was passed in 1993. Subsequently, this act was replaced by the market-friendly rules and regulations called as Foreign Exchange Management Act in 1999. The Reserve Bank of India delegated powers to authorized dealers to release foreign exchange for variety of reasons. The next development was rupee foreign currency swap market, and this was permitted. Next, hedging instruments such as foreign currency rupee swap options, currency cross-currency rupee options, interest rate swaps, currency swaps, caps, collars, and forward rate agreements were introduced to develop the foreign exchange market in India. We should also learn the different terminologies used in the foreign exchange market. The first terminology is called as Libor. Libor stands for London Interbank Offered Rate. This is actually a set of several benchmarks that reflect the average interest rate at which large global banks can borrow from each other. Libor is basically announced in England, and there are total of 35 Libor rates posted each day, and interest rates are compiled for loans with 7 different maturities or due dates for each of the 5 major currencies, including Swiss franc, euro, pound sterling, Japanese yen, and the US dollar. There is another terminology which is very popular in India. It is called as Mybor. Mybor stands for Mumbai Interbank Offered Rate and is closely modeled on the Libor. Mybor was launched on 15th June 1998 by the Committee for Development of the Debt Market as an overnight rate. NSEIL launched the 14-day Mybor on 10th November 1998 and 1 month and 3 month Mybors on December 1st, 1998. Mybor rates have been used as benchmark rates for majority of the money market deals in India. Foreign Exchange Regulation Act, which we discussed earlier, popularly known as FERA, was first introduced through a series of rules under the Defence of India Act in 1939 on a temporary basis. The foreign exchange crisis persisted for a long time, and finally the said act was enacted as a statute under the title Foreign Exchange Regulation Act 1947. This act was subsequently replaced by Foreign Exchange Regulation Act 1973, which came into force from 1st of January 1974, and it was regulating the foreign exchange for more than 26 years under this act. FERA, as it's popularly known as, is basically a criminal law. Since it was a criminal law, it had completely negative impact on the economic development of the country. It tied the hands of the big corporate houses to expand their business. The policymakers felt that some relaxation is required if at all the country needs an economic development, more particularly through industrialization, so that the economy can develop speedily. So, keeping in view this particular aspect, FERA was amended, or rather replaced, by a new act called as Foreign Exchange Management Act 1999, and this was implemented with effect from 1st June 2000. Under FEMA, provisions related to foreign exchange were modified and liberalized so as to simplify foreign trade. Government did this with a hope that FEMA will make favorable development in foreign money market. What are the important features of Foreign Exchange Management Act is also required for all of us to study. Number one, it is consistent with full current account convertibility and contains provisions for progressive liberalization of capital account transactions. Number two, it is more transparent in its application and it lays down areas requiring specific permissions of RBI, Government of India on acquisition or holding of foreign exchange. It is classified the transactions into two categories. Number one, capital account, and number two, current account transactions. Next point, it provides power to RBI for specifying in consultation with the central government the classes of capital account transactions and limits to which exchange is admissible for such transactions. As I said, FERA was a criminal law, whereas FEMA is a civil law. And contraventions of this act provides arrest only in exceptional cases. So liberalized act, in fact, it enhanced the confidence of the big corporate houses so that they can freely transact into foreign exchange market. FEMA does not apply to Indian citizens resident outside India. Let us have a look at the difference between FEMA and FERA. FEMA 2000 and FERA 1973. Number one, it differs in contents. In FERA, there are 81 sections, and out of which 32 sections relate to operational part and rest deals only with penalty, appeals, etc. Whereas in case of FEMA, there are 49 sections as against 81 in FERA, and out of which 12 sections relate to operational part and rest with penal provisions. In nature also it differs. FERA considered as a criminal law, FEMA is a civil law. Applicability, FERA is applied to all citizens of India and to branches and agencies outside India and to branches and agencies outside India also, as I said. Whereas FEMA applies to all branches, offices and branches outside India owned or controlled by person resident in India. This is a basic difference. The new terms which have been introduced in FERA, where it was not having any terms specifically defined, whereas in FEMA they have specifically defined capital account transactions, current account transactions, services, etc. So this is the basic difference between FEMA and FERA. Who are governing the enforcement of FEMA? The authorities for governing enforcement of FEMA, basically number one, Reserve Bank of India, Foreign Exchange Department. The Revenue Department, Ministry of Finance, Director of Enforcement is the enforcing authority. Capital Market Division, it is controlled by Department of Economic Affairs, Ministry of Finance. Foreign Trade Division, Department of Economic Affairs, Ministry of Finance. These are all the regulating authorities for enforcement of FEMA. It's also important for us to know the important sections in FEMA. The main sections, section 2 gives definitions of the act and the terminologies. Section 3, dealing in foreign exchange. Section 4 deals with holding of foreign exchange. Section 5 deals with current account transactions and what are the terms, the things which are included in current account transactions. Section 6 deals with capital account Section 7, export of goods and services. Section 8 deals with realization and repatriation of foreign exchange. Section 9 deals with exemption from Section 8. Section 8 deals with declarations which are required to be made under FEMA. And Section 10, subpara 6 deals with freedom to utilize foreign exchange. And sections 13 to 15 specify penal provisions under the Foreign Exchange Management Act. So we need to go through specific sections relevant when we are dealing with